Question 1. Which of the following best describes the primary purpose of facultative reinsurance? A. To provide coverage for specific high-risk policies outside of a treaty agreement. B. To automatically cede all risks from one insurer to another based on a standard treaty. C. To offer proportional coverage in a shared pool of risks among several insurers. D. To manage risk associated with large losses by creating a stop-loss arrangement. Answer A. To provide coverage for specific high-risk policies outside of a treaty agreement. Explanation. Facultative reinsurance refers to the reinsurance of individual risks, typically for high-risk or large-value policies. Unlike treaty reinsurance, which automatically covers a predefined group of policies or risks, facultative reinsurance is negotiated on a case-by-case basis. This allows primary insurers to obtain coverage for particularly risky or unusual policies that may not be adequately covered under their standard treaty arrangements. Option B describes treaty reinsurance, not facultative. Option C describes proportional reinsurance, where risks are shared among insurers, which is not the focus of facultative. Option D describes a non-proportional structure stop-loss, which is not typical for facultative reinsurance. Question 2. Mr. Thompson has a treaty reinsurance arrangement with a reinsurer, but due to an unexpected increase in policyholder claims, his current reserve funds are insufficient to cover the claims. What should Mr. Thompson do under the terms of his reinsurance agreement to mitigate this issue? A. Request an additional premium adjustment from the reinsurer based on his claims experience. B. Request a non-proportional reinsurance coverage to protect against catastrophic losses. C. Uses facultative reinsurance option to cede specific claims outside of the treaty agreement. D. Attempt to negotiate an immediate reduction in the reinsurer's obligations under the treaty. Answer A. Request an additional premium adjustment from the reinsurer based on his claims experience. Explanation. In treaty reinsurance, the reinsurer is typically bound by the terms of the agreement to share in the underwriting risk and to cover claims up to certain limits. If claims exceed expectations, the insurer may request an additional premium adjustment, reflecting the increase in risk. This adjustment is often based on the claims experience over a certain period in order to help the insurer maintain its financial solvency and meet its obligations. Option B refers to a type of reinsurance arrangement, but this doesn't address the immediate need for premium adjustments. Option C involves facultative reinsurance, which is typically used for individual risks and not necessarily applicable to managing treaty-related claims. Option D would not be appropriate since treaty terms are typically binding and negotiation to reduce obligations may violate the agreement. Question 3. A reinsurance treaty specifies a limit on the amount the reinsurer will pay for claims arising from a single event. The limit is set at $10 million and the total claims for the event amount to $25 million. How much of the claim will the reinsurer cover? A. $25 million, as the reinsurer is required to cover the entire claim under treaty terms. B. $15 million, as the reinsurer covers the claims up to the limit, leaving the remaining amount with the insurer. C. $10 million, as the reinsurer's liability is capped by the terms of the treaty. D. $5 million, as the reinsurer is only responsible for the proportionate amount based on risk sharing. Answer C. $10 million, as the reinsurer's liability is capped by the terms of the treaty. Explanation. In reinsurance treaty, the reinsurer's liability is typically subject to limits agreed upon in the contract. In this case, the treaty specifies that the reinsurer will cover up to $10 million for single event. Therefore, even though the total claims amount to $25 million, the reinsurer will only pay up to its specified limit, leaving the remaining balance for the insurer to cover. Option A is incorrect because the reinsurer's liability is not unlimited. It is capped by the terms of the treaty. Option B is incorrect because the reinsurer only covers the amount up to the agreed limit, which is $10 million, not partial amount. Option D describes proportional approach, but the correct answer is about the cap on liability, not risk sharing. Question 4. Which of the following is a primary function of non-proportional reinsurance? A. To allow for the sharing of premiums between the insurer and reinsurer based on a fixed percentage. B. To cover losses that exceed a certain threshold or limit, such as in excess of loss reinsurance. C. To provide a fixed amount of reinsurance coverage for every policy written by the insurer. D. To automatically include certain risks in a treaty without requiring additional negotiations. Answer B. To cover losses that exceed a certain threshold or limit, such as in excess of loss reinsurance. Explanation: non-proportional reinsurance primarily deals with losses that exceed a specific threshold as seen in excess of loss reinsurance. Under this type of reinsurance arrangement, the reinsurer only steps in to cover losses that go beyond the specified limit, known as the retention amount. This differs from proportional reinsurance, where the reinsurer shares in both the premiums and losses on a fixed percentage basis. Option A refers to proportional reinsurance, not non-proportional. Option C refers to proportional reinsurance as well, where the reinsurer shares a fixed percentage of premiums and claims. Option D describes treaty reinsurance, which is not directly related to the purpose of non-proportional reinsurance. Question 5. MS. Kelly's company has a quota share reinsurance arrangement. If the company writes $50 million in premiums for the year and the reinsurer assumes 40% of the premiums, how much premium will the reinsurer receive? A. $50 million. B. $40 million. C. $20 million. D. $12 million. Answer: C. $20 million. Explanation: quota share reinsurance is a type of proportional reinsurance where the reinsurer receives a fixed percentage of the premiums and covers the corresponding percentage of the claims. In this case, since the reinsurer assumes 40% of the premiums, the amount it will receive is calculated as follows: 40% x 50 million equals 20 million. Therefore, the reinsurer will receive 20 million in premiums. Option A is incorrect as it represents the total premiums written, not the amount the reinsurer assumes. Option B is incorrect because it doesn't reflect the 40% share the reinsurer receives. Option D is too low as it does not reflect the 40% allocation. Question 6. Mr. Adams has an excess of loss reinsurance agreement with a retention limit of $5 million. If a claim of $8 million occurs, how much will the reinsurer cover under this agreement? A. $8 million as the reinsurer covers the entire claim. B. $5 million as the reinsurer only covers losses up to the retention limit. C. $3 million as the reinsurer will only cover the amount exceeding the retention. D. $7 million as the reinsurer covers everything above the retention limit except $1. Answer: C. $3 million as the reinsurer will only cover the amount exceeding the retention. Explanation: in an excessive loss reinsurance agreement, the insurer retains losses up to a certain limit, in this case $5 million. Any claims that exceed this retention amount are covered by the reinsurer. In this case, the claim is $8 million, so the reinsurer will cover the difference between the total claim and the retention limit, 8 million. 5 million equals 3 million. Therefore, the reinsurer will cover $3 million. Option A is incorrect because the reinsurer does not cover the entire claim, only the excess above the retention limit. Option B is incorrect as the reinsurer only covers losses exceeding the retention, not up to the retention. Option D is incorrect because the reinsurer only covers the excess of the claim, not the full amount minus $1. Question 7. Which of the following is a key characteristic of facultative reinsurance that distinguishes it from treaty reinsurance? A. Facultative reinsurance automatically covers all policies under an agreement between the insurer and reinsurer. B. Facultative reinsurance provides coverage on a case-by-case basis for specific risks. C. Facultative reinsurance requires the insurer to automatically cede a portion of every policy. D. Facultative reinsurance involves shared premiums and claims in fixed percentages. Answer: B. Facultative reinsurance provides coverage on a case-by-case basis for specific risks. Explanation: facultative reinsurance is negotiated individually for each risk, allowing the insurer to obtain reinsurance for specific, often high-risk policies that may fall outside the scope of standard treaty agreements. This allows the insurer flexibility to cede specific risks that may be too large or too risky for them to retain on. Option A refers to treaty reinsurance, which automatically covers a group of policies. Option C describes treaty reinsurance, where a portion of every policy is ceded to the reinsurer. Option D refers to proportional reinsurance, which involves shared premiums and claims based on fixed percentages, a feature of quota share arrangements, not facultative. Question 8. How does the use of catastrophe bonds in reinsurance help manage large-scale risks? A. By transferring risk to the market and providing a fixed payout in the event of a catastrophe. B. By covering specific claims based on the insurer's current premium income. C. By lowering the reinsurer's obligations for claims related to weather events. D. By automatically reimbursing the insurer's reserve funds in case of a catastrophic event. Answer A. By transferring risk to the market and providing a fixed payout in the event of a catastrophe. Explanation: catastrophe bonds are a form of insurance-linked security yields that allow insurers to transfer the risk of large catastrophic events like natural disasters to investors in the event of a specified catastrophe. The bond triggers a payout to the insurer, helping them manage the financial impact of such events. The use of these diversifies the risk pool and provides the insurer with additional capital without traditional reinsurance. Option B is incorrect because catastrophe bonds are not tied to premium income but rather to the occurrence of a catastrophic event. Option C is incorrect as catastrophe bonds provide direct payouts for catastrophic events rather than lowering reinsurer obligations. Option D is incorrect as catastrophe bonds are not designed to replenish reserves automatically but to provide capital in the aftermath of catastrophes. Question 9. What is the primary purpose of a loss portfolio transfer in reinsurance? A. To provide a fixed percentage of coverage on new claims arising from an insurer's policies. B. To transfer the financial liability of past claims to a reinsurer, typically for a lump sum. C. To mitigate risks by pooling together claims from multiple insurers into a shared risk pool. D. To increase an insurer's market share by obtaining reinsurance for specific high-value risks. Answer B. To transfer the financial liability of past claims to a reinsurer, typically for a lump sum. Explanation: a loss portfolio transfer (LPT) is a reinsurance arrangement in which an insurer transfers the liability for existing claims losses that have already been incurred to a reinsurer, usually for a lump sum payment. This allows the insurer to clean up its balance sheet and mitigate the financial impact of outstanding, while the reinsurer assumes the ongoing responsibility for those claims. Option A describes a different form of reinsurance and does not refer to loss portfolio transfers. Option C refers to pooling, which is a different risk management technique not directly related to loss portfolio transfers. Option D describes general reinsurance strategies, but not specifically the purpose of loss portfolio transfers. Question 10. Which of the following best describes the role of a reinsurance broker in a reinsurance transaction? A. To provide the insurer with an automatic ceding of all risks to the reinsurer. B. To negotiate terms between the insurer and reinsurer, ensuring both parties' needs are met. C. To manage claims on behalf of the reinsurer and settle payments. D. To directly underwrite policies and assume the risk for the insurer. Answer B. To negotiate terms between the insurer and reinsurer, ensuring both parties' needs are met. Explanation: reinsurance brokers act as intermediaries who help insurers and reinsurers find mutually agreeable terms for reinsurance contracts. They have expertise in negotiating the best terms, understanding the needs of both parties, and facilitating the arrangement of the reinsurance agreement. They do not underwrite policies, directly manage claims, but they play a key role in the transaction process. Option A is incorrect because brokers do not automatically cede risks but instead facilitate negotiations. Option C refers to the reinsurer's role, not the broker's, who does not manage claims. Option D refers to underwriters, not brokers. Brokers facilitate the transaction but do not directly assume risks. Question 11. Which of the following statements best describes the concept of ceding in reinsurance? A. Ceding is the process by which the reinsurer agrees to take on risk from the primary insurer. B. Ceding is the process by which the primary insurer transfers part of its risk to the reinsurer. C. Ceding is when the primary insurer assumes all risk from the reinsurer. D. Ceding is when the reinsurer underwrites new policies for the primary insurer. Answer B. Ceding is the process by which the primary insurer transfers part of its risk to the reinsurer. Explanation: ceding refers to the process where the primary insurer, cedent, transfers part of its risk or liability to the reinsurer. This can be done in various forms of reinsurance, such as proportional or non-proportional reinsurance. Option A is incorrect because the reinsurer does not initiate the ceding process. The insurer does. Option C is incorrect because it refers to the opposite of ceding, which would involve the insurer assuming the entire risk. Option D is incorrect because underwriting policies is the responsibility of the insurer, not the reinsurer. Question 12. In a proportional reinsurance arrangement, the reinsurer typically A. only assumes liability for risks exceeding a certain threshold. B. shares in the premiums and claims based on a fixed percentage. C. covers only catastrophic losses. D. assumes all risk for a specific type of coverage. Answer: B. shares in the premiums and claims based on a fixed percentage. Explanation: in proportional reinsurance, the insurer and the reinsurer share the premiums and losses according to a predetermined percentage. This can be structured as a quota share or surplus share reinsurance agreement. Option A refers to non-proportional reinsurance, excessive loss, not proportional reinsurance. Option C refers to catastrophic reinsurance, which is typically non-proportional. Option D is incorrect because proportional reinsurance involves a fixed percentage share, not an assumption of all risk. Question 13. Which of the following reinsurance types typically covers catastrophic events, such as natural disasters? A. treaty reinsurance. B. excessive loss reinsurance. C. facultative reinsurance. D. proportional reinsurance. Answer: B. excessive loss reinsurance. Explanation: excessive loss reinsurance is used to cover large, unpredictable events such as natural disasters. The reinsurer covers only the losses above a certain threshold retention, making it well suited for catastrophic events. Option A refers to an agreement that can cover a variety of risks but is not specifically designed for catastrophic events. Option C refers to facultative reinsurance, which is negotiated for specific risks, not necessarily catastrophic ones. Option D refers to proportional reinsurance, which deals with a fixed percentage of premiums and claims, but not specifically catastrophic losses. Question 14. In a quota share reinsurance agreement, if the ceding company retains 60% of the premiums and cedes 40% to the reinsurer, what percentage of claims does the reinsurer typically cover? A. 60%. B. 100%. C. 40%. D. 50%. Answer: C. 40%. Explanation: in a quota share reinsurance agreement, both premiums and claims are shared according to the agreed upon percentage. If the ceding company retains 60% of the premiums, it also retains 60% of the claims. The reinsurer, assuming 40% of the premiums, will cover 40% of the claims. Option A is incorrect because the reinsurer does not cover 60% of the claims. Option B is incorrect as the reinsurer's share is 40%, not the entire claim. Option D is incorrect because the reinsurer's share is 40%, not 50%. Question 15. Which type of reinsurance allows the ceding company to transfer a large individual risk on a case-by-case basis? A. facultative reinsurance. B. treaty reinsurance. C. excessive loss reinsurance. D. proportional reinsurance. Answer A. facultative reinsurance. Explanation: facultative reinsurance is a form of reinsurance where the ceding company transfers individual risks to the reinsurer on a case-by-case basis. This type of reinsurance allows the insurer to seek coverage for specific, often large or unusual risks that may fall outside of a treaty. Option B refers to treaty reinsurance, which involves covering a group of risks, not individual cases. Option C refers to excessive loss reinsurance, which covers large losses that exceed a certain threshold. Option D refers to proportional reinsurance, which shares premiums and losses based on fixed percentages but is not case-specific. Question 16. What does retention mean in a reinsurance agreement? A. The amount of risk that the reinsurer assumes. B. The portion of the premium that the insurer keeps. C. The amount of risk that the ceding company retains before the reinsurer's coverage kicks in. D. The amount of coverage the reinsurer offers for catastrophic events. Answer C. The amount of risk that the ceding company retains before the reinsurer's coverage kicks in. Explanation: retention refers to the amount of risk that the ceding company retains before the reinsurer becomes liable for additional claims. It acts as the threshold that must be exceeded for the reinsurer to step in and cover the losses. Option A is incorrect because retention refers to the insurer's retained risk, not the reinsurer's assumed risk. Option B is incorrect because retention refers to risk, not premiums. Option D refers to excessive loss reinsurance but is not the general definition of retention. Question 17. How does a reinsurer typically benefit from the use of reinsurance? A. By eliminating all risk from the insurer. B. By pooling risks to achieve greater diversification. C. By controlling the underwriting process for the primary insurer. D. by reducing the insurer's premiums directly. Answer B. By pooling risks to achieve greater diversification. Explanation: reinsurers benefit from diversification by pooling a variety of risks. This allows them to spread the risk across different geographic regions, types of coverage, and other factors, reducing their exposure to catastrophic events or large claims from any one source. Option A is incorrect because reinsurance does not eliminate risk but rather helps to manage it. Option C is incorrect as reinsurers do not control the underwriting process of primary insurers. Option D is incorrect because the reinsurer does not directly reduce premiums but rather shares risk. Question 18. What is a primary advantage of using non-proportional reinsurance over proportional reinsurance? A. It provides more predictable premium and claim sharing arrangements. B. It allows the insurer to transfer the risk of catastrophic losses to the reinsurer. C. It automatically covers all risks, including those with no claims. D. It involves the sharing of premiums in fixed percentages. Answer: B. It allows the insurer to transfer the risk of catastrophic losses to the reinsurer. Explanation: non-proportional reinsurance, such as excessive loss reinsurance, is specifically designed to cover large catastrophic losses. This allows the insurer to transfer the risk of significant events, such as natural disasters, to the reinsurer without sharing premiums and claims in fixed percentages as in proportional reinsurance. Option A is incorrect because non-proportional reinsurance typically deals with large losses, making the premium and claims less predictable. Option C is incorrect as non-proportional reinsurance covers only losses exceeding the retention amount. Option D refers to proportional reinsurance, not non-proportional. Question 19. In a surplus share reinsurance agreement, if the ceding company retains $1 million per policy and cedes 60% of any amount over that, how much will the reinsurer pay for? A claim of $3 million. A. $1.8 million. B. $2 million. C. $1 million. D. $2.4 million. Answer A. $1.8 million. Explanation: in a surplus share reinsurance arrangement, the reinsurer pays a percentage of any claim that exceeds the insurer's retention. If the ceding company retains $1 million per policy and cedes 60% of the amount over that, the reinsurer will pay 60% of the $2 million in excess of the $1 million retention. 60% x 2 mil equals 1,008,000. Thus, the reinsurer pays $1.8 million. Option B is incorrect as the reinsurer does not pay the full excess amount. Option C is incorrect because the reinsurer does not pay the retention portion, just the excess. Option D is incorrect because it overestimates the reinsurer's share. Question 20. What is a binding authority in the context of reinsurance? A. A legal obligation for the reinsurer to accept all risks from the ceding company. B. A document that outlines the terms and conditions of the reinsurance contract. C. An agreement that allows a broker or agent to bind a reinsurer to specific terms without further approval. D. A report required by the reinsurer to assess potential risks. Answer: C. An agreement that allows a broker or agent to bind a reinsurer to specific terms without further approval. Explanation: binding authority allows a broker or agent to enter into reinsurance agreements on behalf of the reinsurer without needing additional approval for each individual transaction. This enables quicker processing of reinsurance agreements and facilitates more efficient risk management. Option A is incorrect because binding authority does not obligate the reinsurer to accept all risks, only the risks specified in the agreement. Option B refers to the contract itself but not the authority to bind a reinsurer. Option D is incorrect as binding authority is not a risk assessment tool but a mechanism for entering agreements. Question 21. Which of the following is a characteristic of a stop-loss or reinsurance agreement? A. It covers claims exceeding a certain amount up to a specified limit. B. It transfers risk on a case-by-case basis. C. It provides coverage once the insurer's claims exceed a set aggregate amount. D. It shares premiums and claims based on a fixed percentage. Answer: C. It provides coverage once the insurer's claims exceed a set aggregate amount. Explanation: stop-loss reinsurance is a form of non-proportional reinsurance where the reinsurer covers losses once the insurer's total claims exceed predetermined aggregate amount. This helps the insurer protect against unusually high total losses. Option A refers to excessive loss reinsurance, which is more specific to individual claims. Option B describes facultative reinsurance, not stop loss. Option D refers to proportional reinsurance, not stop loss. Question 22. Which of the following reinsurance types is most suitable for covering the tail end of claims in a claims-made policy? A. Facultative reinsurance. B. Excessive loss reinsurance. C. Claims-made reinsurance. D. Runoff reinsurance. Answer: D. Runoff reinsurance. Explanation: Runoff reinsurance is designed to cover claims that occur after a claims-made policy expires, often covering liabilities that arise from past incidents that have not yet been reported. Option A is incorrect because facultative reinsurance applies to individual risks. Option B is incorrect because excessive loss reinsurance addresses large claims, not claims arising from past incidents. Option C is incorrect because claims-made reinsurance does not address claims after the policy ends, unlike runoff reinsurance. Question 23. Which of the following is the primary reason an insurer may use facultative reinsurance? A. To cover large individual risks that fall outside of a treaty agreement. B. To obtain a fixed percentage of premium income. C. To automatically cede all risks to the reinsurer. D. To cover general routine claims. Answer A. To cover large individual risks that fall outside of a treaty agreement. Explanation: Facultative reinsurance is typically used for individual large or unusual risks that are not included in the terms of an existing treaty agreement. It allows the insurer to secure coverage for risks that do not fit into their usual reinsurance arrangements. Option B refers to proportional reinsurance, not facultative reinsurance. Option C describes treaty reinsurance, not facultative reinsurance. Option D is incorrect as facultative reinsurance addresses specific risks, not routine claims. Question 24. Which of the following is a typical feature of treaty reinsurance? A. It is negotiated for individual risks on a case-by-case basis. B. It automatically covers a portfolio of risks as defined by the agreement. C. It requires the ceding company to get approval for each individual risk from the reinsurer. D. It focuses solely on catastrophic losses. Answer: B. It automatically covers a portfolio of risks as defined by the agreement. Explanation: Treaty reinsurance is an ongoing agreement between the ceding company and the reinsurer that automatically covers a portfolio of risks. It does not require individual negotiations for each risk, unlike facultative reinsurance. Option A refers to facultative reinsurance where individual risks are covered separately. Option C is incorrect because treaty reinsurance does not require approval for each individual risk. Option D refers more to excessive loss reinsurance, not treaty reinsurance. Question 25. What is the primary purpose of retrocession in reinsurance? A. To allow a primary insurer to reinsure part of its risk with another insurer. B. To allow a reinsurer to transfer part of the risk it has assumed to another reinsurer. C. To cover catastrophic losses by transferring risk to a third-party insurer. D. To pool risks and premiums across multiple insurers. Answer: B. To allow a reinsurer to transfer part of the risk it has assumed to another reinsurer. Explanation: Retrocession is the process by which a reinsurer transfers some or all of the risk it has assumed from the ceding insurer to another reinsurer. It helps the reinsurer manage its own exposure to large losses. Option A is incorrect because retrocession applies to reinsurers, not primary insurers. Option C refers to excessive loss reinsurance but does not describe retrocession. Option D is more associated with pooling arrangements, not retrocession. Question 26. Which of the following best describes the catastrophic excessive loss reinsurance? A. It protects against large unexpected claims that exceed a set amount, such as natural disasters. B. It covers routine claims up to a specified amount. C. It shares premiums and claims in fixed percentages. D. It automatically covers all risks, including those without claims. Answer A. Protects against large, unexpected claims that exceed a set amount, such as natural disasters. Explanation: Catastrophic excessive loss reinsurance is designed to protect the insurer against large, unexpected losses, such as those arising from natural disasters. The reinsurer pays for losses that exceed a predefined threshold, helping the insurer manage its exposure to such events. Option B refers to standard coverage, not catastrophic reinsurance. Option C describes proportional reinsurance, not excessive loss reinsurance. Option D is incorrect as catastrophic reinsurance only covers large losses, not all risks. Question 27. What is the main difference between facultative and treaty reinsurance? A facultative reinsurance covers large individual risks, while treaty reinsurance covers a group of risks automatically. B. Facultative reinsurance covers all risks automatically, while treaty reinsurance covers large individual risks. C. Facultative reinsurance is more expensive than treaty reinsurance. D. Facultative reinsurance does not require a contract, while treaty reinsurance does. Answer A. Facultative reinsurance covers large individual risks, while treaty reinsurance covers a group of risks automatically. Explanation. The main difference between facultative and treaty reinsurance is that facultative reinsurance covers individual, specific risks on a case-by-case basis, while treaty reinsurance covers a group of risks automatically under a continuous agreement. Option B is incorrect as it reverses the characteristics of facultative and treaty reinsurance. Option C is a generalization that isn't always true. Option D is incorrect because both facultative and treaty reinsurance typically involve formal contracts. Question 28. What does reinsurance to close refer to? A. A method by which reinsurers cede all of their risks to another insurer. B. The practice of closing out a reinsurance contract by paying claims or transferring obligations. C. A process in which an insurer agrees to absorb all future claims. D. A mechanism to assess the financial stability of a reinsurer. Answer B. The practice of closing out a reinsurance contract by paying claims or transferring obligations. Explanation. Reinsurance to close is a process where a reinsurance contract is effectively closed by selling outstanding claims or transferring obligations. It is typically used in run-off situations where the reinsurer takes responsibility for all claims related to a closed book of business. Option A is incorrect because reinsurance to close does not involve ceding risks to another insurer. Option C is incorrect because the insurer does not absorb future claims but settles existing obligations. Option D refers to financial assessment, not reinsurance to close. Question 29. What is meant by the term combined ratio in the context of reinsurance? A. A measure of the profitability of the reinsurance company calculated by dividing claims paid by premiums collected. B. A formula to calculate the total premiums generated from a reinsurance portfolio. C. A metric that determines the level of retention in a reinsurance agreement. D. A calculation of the total value of risk ceded to the reinsurer. Answer A. A measure of the profitability of the reinsurance company calculated by dividing claims paid by premiums collected. Explanation. The combined ratio is a measure of profitability used by insurance and reinsurance companies. It is calculated by adding the loss ratio claims paid to premiums earned and the expense ratio expenses to premiums earned. A ratio above 100% indicates the company is paying out more claims and expenses than it is earning in premiums. Option B is incorrect because the combined ratio is about profitability, not premiums. Option C refers to retention, not the combined ratio. Option D is incorrect because it does not describe the combined ratio's purpose. Question 30. What is the typical purpose of per-risk excessive loss reinsurance? A. To cover the total aggregate losses of the insurer across all risks. B. To cover the losses from individual risks that exceed a predetermined amount. C. To automatically share all premiums and claims in fixed percentages. D. To cover catastrophic events that affect large parts of the insurer's portfolio. Answer B. To cover the losses from individual risks that exceed a predetermined amount. Explanation. Per-risk excessive loss reinsurance is designed to cover individual risks that exceed a set threshold, such as losses from a single policyholder or a single event. It is often used to protect the insurer against large claims that result from specific risks. Option A refers to aggregate reinsurance, not per-risk excessive loss. Option C describes proportional reinsurance, not excessive loss. Option D refers more to catastrophic reinsurance, which covers large-scale losses.